to go broke in the stock market in 10 fun and easy steps. If you're like me and you're looking to learn how to go broke in the stock market, well, keep on watching. This video's for you. You know, it happens to the best of us. We get all excited about investing in the stock market only to have our money disappear overnight. And it's not like we're talking about a few $100s here. Typically, if you're anything like the average investor, we're talking about just going broke. But what if you're one of these people who actually is interested in losing all their money in the stock market? Now, why would you want to lose all your money in the stock market, you might ask? Well, maybe you're just tired of having so much money. Alternatively, you could just be curious as to what normally happens during bankruptcy proceedings. Or maybe you just want to spend more time with your local homeless brothers and sisters. No matter what the reasoning is, by the end of this video, you'll be a self-deprecating investment pro, skilled in all the means of losing your money in the stock market, and you'll be on your way to crashing your entire life savings. You're watching Finance Squared. I'm Derek West, and we love making complex financial topics plain and simple. And let me tell you, nothing is easier than losing all your money trading in the stock market. So, lovingly, tenderly, gently, smash that like button and subscribe, turn on post notifications for that YouTube algorithm so you can get more great tips on how to lose all your cash. Heck, even some tips on how to do things the right way. The first thing you want to do if you want to learn how to go broke in the stock market is to invest in high-risk stocks. Now remember, all investments involve risk. And the more you risk, the higher your potential reward. But on the flip side, the greater your losses if that risk doesn't pan out. Or rather, if that risk materializes. You see, the more volatile the stock, the greater the chance it will lose value quickly. So, look for stocks with a beta coefficient higher than 1. This means that they're more volatile than the overall market and are therefore more likely to see large price swings. If you're looking to ignore your own financial security, investing in high-risk stocks is a surefire way to achieve that goal. High-risk stocks are usually those that are highly volatile and have a higher chance of defaulting. While they may offer the potential for high rewards, they also come with a high degree of risk. As a result, investors across the globe that tend to invest in high-risk stocks often see their investment portfolios take a major hit when the market takes a turn for the worst, like in the tumultuous times we're going through right now. So if you're looking to lose money quickly, break into that emergency fund and start investing into high-risk stocks. Well, that's a definite way to go. Speaking of high-risk stocks, how about investing in penny stocks? They're a great way to lose money quickly. For the uninitiated, penny stocks are shares of companies that trade for less than $5 per share. They're often penny-wise and pound-foolish investments, and they're a great way to lose money quickly. The vast majority of penny stocks, well, they're worthless, because most penny stock companies are thinly traded, highly leveraged, and have questionable accounting practices. And even if you do happen to find a gem among the bunch, it's hard to unload your shares when no one else will spend money buying those same penny stocks. Why aren't people buying penny stocks? Because most people in the stock market tend to want to make money. But not you. You're a renegade. So if you're a day trader with years of trading experience and a track record of success under your belt, well, you're probably steering clear of penny stocks. But then again, you're probably looking to increase your wealth and not go broke in the stock market. Trade stock funds on margins. Next up, if you're really looking to lose money in the stock market, trade on margin without fully understanding the risks involved. You see, stock trading on margin can be a very risky proposition, even for the most experienced investor. When you're trading stocks on margin, you're essentially borrowing money from your broker to purchase shares. This can magnify both your gains and your losses. Reason being, the expense of the transaction goes up because you'll owe your broker some money over the transaction. What's more, if the stock price falls below a certain level, you may be required to provide additional collateral to cover that loan. So not only will the value of your holdings be worthless, but you'll owe money as well. One of the age-old pieces of advice is to never put all your eggs in one basket. However, when it comes to trading stocks on margin, many people are willing to do just that. Now, here's a pro tip if you're really trying to lose money. Consider trading high-risk or penny stocks on margin if you're really trying to amplify those losses. Follow stock tips from unreliable sources instead of doing your own research. There are all sorts of stock tips out there, and it can be tough to know who to trust. After all, even the most reliable sources can be right sometimes, and if you're trying to lose money and jeopardize your financial security, well, we just can't have that. So, instead of doing your own research or following investment advice from reliable sources with track records of investing success, why not just follow tips from unreliable sources? That way, you can be sure that you're getting bad information. And if your investments go south, frying your retirement nest egg, you can always blame the source. After all, it's not your fault for following bad advice. It's their fault for giving you bad advice. So go ahead and take that stock tip from the guy at that bar. It might just make you rich, or more than likely, it'll make you lose a lot of money. But either way, you'll have a good story to tell. Buy high and sell low. Buying low and selling high is a popular investment strategy among those looking to make money in the stock market. But that's not you. You're trying to have a good time and be a renegade. So you're trying to lose money in the stock market. You see, buying low and selling high, it's probably the most common investment strategy among traders and investors of all stripes. The idea is simple. Buy an asset when it's relatively cheap and then sell it when it's expensive. But if you're looking to spend more time in a bankruptcy court, you want to do the exact opposite. You want to buy high and sell low. That way you spend as much of your money as possible when you buy and then lose most of that investment when you sell, locking in those losses. In addition to that, buying high and selling low goes against basic principles of investing, particularly if you're looking to make money. What does that tell us? That tells us if you're serious about losing money in the stock market, follow the herd and sell low after buying high. And that's easy to do when you panic when the market takes a downturn. Panic selling is often cited as one of the main reasons why investors lose money in the stock market. When the market takes a downturn, unprepared investors can quickly become overwhelmed with fear. In the heat of the moment, they typically sell all their stocks or a portion of their stocks at a loss without considering the long-term implications of their actions. Panic selling can also trigger a domino effect, particularly during times of downturns. As other investors, they see you selling off and they begin to sell their stocks in a mad dash to be the one to sell their stocks first. This can cause the market to decline further, amplifying the losses of those who sold during the panic. It's a great big game of duck, duck, goose. The first person to sell typically is the one to win. The real key to losing money during panic selling is to be brave enough to wait for the stock market to decline a certain amount and then sell at the end of the panic. This way, you lose as much money on the stock as possible. If you're really trying to lose as much money as possible in the stock market, you need to ignore your investment accounts and your portfolio for months or years at a time. It's common practice for those who are looking to lose money in the stock market to ignore their investment portfolio for months or years at a time, and then try and play catch-up when the market has already recovered. This is a form of buying high and selling low. You see, after the stocks in your portfolio have taken a nosedive and your portfolio becomes next to worthless, you naturally just want to focus on something else. Trust this instinct, particularly if you're trying to lose money. Instead of riding the ship, loading up on solid companies with proven track records that you discovered by doing intensive research, just let your portfolio sit there with all the losses mounting. After all, you haven't lost money if you still think it's there, right? What was that about a tree falling in the woods and nobody hearing it? Next up, you definitely don't want to invest in index funds or ETFs. Listen, index funds and ETFs that track major indices like the S&P 500, they've outperformed up to 80% of actively managed mutual funds and other investment baskets for the last couple of years now. So while they do follow the market when they go down, the investment risk is much lower than single stocks because they're always dropping the least performing stock. Assuming the market eventually rebounds, that means that your portfolio will rebound with it if you stick to it. Now, again, that's for the suckers that are looking to make money in the stock market. If your goal is to lose money in the stock market, those are among the investment options that you're going to want to avoid. You should instead put your money into something that is high risk and likely to lose money, like penny stocks or cryptocurrency. To really amplify those stock market losses, get all your investment ideas from social media, TV, or friends. You see, if losing all your money in the stock market is one of your financial goals, make sure to get all your investment ideas from social media. TV, family, friends. After all, these are some of the least reliable sources of information out there. Your friends probably don't know anything about investing, and social media is full of people with agendas that are often misinformed about the market. Perfect. And as for TV, it's simply entertainment first and foremost, and a great place to be entertained about the markets while you're losing all your money in the markets. See how this works? And it's very easy to be entertained by the markets if you're trading on emotion, not logic. Trading on emotion is one of the surefire ways to lose all your money in the stock market. When you let your emotions like fear and greed guide your investment decisions, you're more likely to make impulsive decisions that are not based on sound logic, which is perfect for losing money. Is the stock market riding high? Well, you're missing out on the action. Go find a hot stock to drop your life savings in. Is the stock market going down? Well, that's just a perfect opportunity to buy more of the same stock that just lost you half your net worth. Dollar cost averaging, target date funds, stock allocation, mutual fund investing, target date fund investing, total stock market index funds or ETFs. None of the technical or fundamental research and analysis matters when you're just trying to lose money. Just react when your emotions are at their peak. See how easy it is to lose money when you let emotions guide your investing decisions? It's like taking candy from a baby, or rather funds from your retirement accounts. And certainly you're going to not want to diversify your portfolio. Remember, losing money in the stock market, you want to make sure not to diversify your portfolio. This way, you can have all your eggs in one proverbial basket. And if that basket ends up being a dud, which it likely will be if you've been following the tips from earlier, your entire portfolio will go down with it. Did you hear a hot stock tip from somebody? Maybe it was a good buddy of yours. Or perhaps you're reading something on Wall Street Bets, or you've heard something on CNBC. Well, that is just a sign from above telling you to invest all your hard-earned cash in that one stock. Here's a bonus for you. don't use tax-efficient accounts or strategies when trading. Investing with pre-tax dollars is for squares. Putting your money into tax-efficient accounts is simply a way to keep yourself from paying too much on taxes. And everyone loves paying as much money as possible on taxes, right? Taking advantage of a 401k, IRA, or other tax-advantaged accounts will only save you money that you had earmarked for massive losses. So when you start investing, do us all a favor and make sure it's done as inefficiently tax-wise as possible. Thanks. So if you wanted to go broke in the stock market and have zero retirement income, just follow those 11 easy steps by investing in high-risk stocks, trading on margin without fully understanding the risk involved, and following unreliable stock tips instead of doing your own research. You're practically guaranteed to lose money. And if things aren't going south fast enough for you, don't hesitate to sell all your stocks at a loss, even if it means wiping out all your previous investment gains. And finally, try not to pay attention to your investment portfolio for months or years at a time, and ignore all sound financial advice. I'm just kidding around. These are all terrible strategies. Nobody should want to lose money in the stock market. In fact, here's what you should do if you're trying to gain money in the stock market. Balance your stock risk allocation between low risk and high risk stocks. Trade on margin responsibly, if at all, particularly if you have the right knowledge and guidance and a good strategy. Only invest in what you understand. Avoid emotional trading based on market volatility or bull runs. Minimize investing in non-tax friendly accounts, and you want to diversify your portfolio. All this is going to take a little bit more effort than blindly following others' investment advice or trading based on your emotions, but it will be well worth it in the end. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. And if your goal is to lose money, follow the first half of this video's advice. But if not, do the opposite. Okay? Thanks, folks. We'll catch you in the next video. Peace.